And hello there. Today is the 28th of September, quarter end coming up on Monday. And let's see what we think about what happened last week, Andy. I think that probably the biggest news was China and what China did to try and reflate its economy. First, do you think it's enough? And do you think it really matters for the US? Here's the question.
Yeah, I mean the way I think of China right now is it's a sort of long drawn out great financial crisis like ours in 2007 and 2008, where the economy got significantly over levered, overbuilt. Many speculators and banks were heavily invested in real estate, and it's the unwinding of that leverage has been depressionary, essentially, because there has been inadequate policymaker action. And, it's been a dream of bulls on the Chinese economy to foreigners, bulls, for them to see meaningful, and there's been lots of jumps and starts on it, to see meaningful policymaker action. And there was meaningful policymaker action that started with the PBOC, the central bank, who lowered interest rates, short-term interest rates, announced plans to lower both deposits for people who have the money at the banks and mortgagees, more importantly, by 50 basis points. And there were, sort of significant loan offerings to banks who would then package those and offer them to investors, both domestic and foreign, to buy stocks. And, those are reasonable monetary easings when you have an economy that is not in the midst of a depression. What I think, and what I think most think, is what's required when you have the classic Keynesian view would be what you need is monetary fiscal stimulus. And the package came toward the end of the week, and it was small. It was, this is an $18 trillion economy with a 1 point, a 2 trillion problem on their hands, a 8 to 10% of GDP sort of problem on their hands. And, they did 2% of GDP in terms of announcements, and the money will go largely to the middle class and the poor. And it's inadequate for the economy to really rebound. But in situations like this, speculators shoot first and aim later. And the Chinese stock market had a huge rally, is now outperforming the S&P this year.
Yes. It absolutely had a huge rally. The question is that good for the US market or not? And really, the US market is different from most other markets, isn't it? Because it's a very self-contained market. What happens abroad tends to affect it least, both to the downside and to the upside. And as we saw last week, what did the S&P do? Where he was up less than 0.5%. So really the S&P was not impressed by this and didn't think that this was going to reflate the world economy to any great extent. And neither did the price of oil, which actually ended down on the week again. So are we really, does what China did change our view in any way about what is happening in the US economy? And I guess from what you are saying and what I think, the answer is no, as far as the US is concerned. But it probably makes us slightly more bullish about international commodities, which we have started shifting into out of the US and into international commodities, equities,
Stocks,
sorry.
yeah, I mean, I think that's right. You have the speculative pump of the Chinese market. Next week, it's closed broadly, though the U.S. ETFs will keep trading likely. So there could be continued sort of, the last oomph of a 30% move, but it's not something you would want to chase because it's unclear to us whether the economic impact is going to be enough to self-sustain consumption in China given their deleveraging. So Talk about the U.S. and the impact. It's probably going, if there is a big consumption boom in China, their trade partners, their in the place where they import stuff from are going to be the most impacted. So places like Europe and Japan would probably benefit well before the United States. Demand for commodities, commodity demand is for industrial consumption and real estate consumption. Neither of those things are what are being targeted by the stimulus. So to us, it seems unlikely that you're going to see a meaningful impact on inflation. You're going to get some consumption, which is inflationary domestically, but that's what their goal is. It's exporting it to the rest of the world is unlikely. Maybe a little tick up in global growth.
Yeah. So what we're basically saying is that China has no big effect on the US, and certainly the way they have structured this package, the totality of this package, it's probably going to benefit most, I don't know, Louis Vuitton. And they're going to be buying, sort of Louis Vuitton bags. They're not really going to be buying anything else that is significant for the US, and therefore the US market reacted least and almost sort of yawned at the China news, which is as it should be, I think. What else happened? What do you think? The PCE was probably the most important thing that happened last week, and nothing much came of that. The bond market yawned at the news that it was rounded down to point 0.1 as opposed to point 0.2, because we all know what the PC is going to be. I just keep on having this feeling that inflation, and especially after the data that we had in Europe on Friday, where inflation actually went negative month over month and is headed to below the ECB target now. So we probably are going to get more ECB cuts, and that was reflected in the local bond markets. I just keep on getting the feeling that much the same thing could happen in the US, and that by the first half of next year, we could be at the Fed's target. And therefore, what they have promised us, the cuts they've promised us in the dot plots, are going to be realized, and maybe even faster than they promised. Do you agree with that view? Do you have a counter view to that?
So so it's a question of term and how quickly all this happens. I do disagree. I think the economy is so. You didn't mention the jobless claims. That was fine.
Yeah,
Um,
they're always fine though.
yeah, yeah,
Every week we look for weaker jobless claims, and every week they are exactly in line.
right. Which to
So,
me represents an economy that is, yeah, and I think you agree. And I think we've been saying this.
absolutely.
No sign of weakness.
No.
So the point on inflation to me is I don't know what inflation's going to do. I think the economy is fine and the Fed is cutting into a strong economy. And that generally is inflationary. And gold is taking that message in a big way. Stocks even are taking that message in a fairly big way. The bond market is being held down by expectations of cuts. And I don't disagree with you that if we start to see further disinflationary numbers from what we are seeing, that the cuts that are priced in will be realized. And I think it's important to note that since since Jackson Hole basically, but certainly since the FOMC meeting, pretty much every governor except Bowman has been speaking from the same hymn book, and that's that they're on a path, they're data dependent, and that data and their bigger concern is the jobs market. However, which to me is not, shouldn't be their concern and shouldn't be why they're cutting, because the economy is strong and there's no sign of weakness in the job market. But they've mentioned that. Only Waller, most recently, was concerned about disinflation like you are. And that tells me that any hot inflation number, and we're bound to get one that's above expectation, these numbers shift around, they're unpredictable, is going to be ignored. and any cold number is going to be supported. So it's going to take a number of hot inflation numbers to turn the sentiment and the market pricing around regarding inflation. And it's hard to think that that's going to happen really soon. I would say that one interesting point is that spot oil is about to drop below forward oil, which is a inflationary signal. It means oil prices are, instead of what it has been for a number of years as the economy has weakened, spot oil has been above forward oil, which signals disinflation because the market expects oil to be lower in the future. That's shifting. I don't know when it'll turn, but with an economy that is strong, with the cuts that are priced in already affecting every market that borrows and lends, and with a very dovish Fed, I'm more 6 month out optimistic about the economy and unfortunately optimistic about inflation, not accelerating, but not coming down to target.
Yeah. I get where you're coming from. I think that this is precisely the wrong time to be adding risk, simply because there are so many unknowns and unknowables. First of all, the most important one being the election, because monetary policy potentially and fiscal policy certainly are going to be very different, if one candidate wins over another, and we will discuss that much closer to the election. No point in doing that now. I just know that from experience, from bitter experience most of the time, is that when the market, like US equities, finds itself at a point where it has very limited upside, it tends to probe the downside. And I think that all the people who bought equities last week and the week before on some Chinese news, or the strong economy or whatever news, are going to regret it in the next few weeks before the election. We what did we see on Friday? We saw that volatility rose for absolutely no reason at all, and that's another sign. So I'm really very cautious here about all markets, whether they be bond markets or whether they be stock markets. I think that we are priced for perfection in both markets, and we are unlikely to get perfection because perfection doesn't exist, as we all know. So, what can happen next week to derail this wonderful everything is going up rally in equities and bonds? Well,
Yeah,
we
so
have NFP, of course, but
right.
apart from that,
So in terms of what's coming, Monday we're going to have month end. And it's slightly bullish bonds in terms of just inflows and duration extension that happens pretty much every month. Bonds have also underperformed, so bonds are likely to be bought and equities sold for rebalance pressures. But there's some fairly technical things which I won't go into in this video regarding a very large options trade that expires on the close. So it's very unpredictable. We could either rally a lot or sell off a lot on Monday. So, we'll communicate if either of those two things happen. But the market, as Nick said, is a little skittish regarding the next month. And again, I agree completely. This is not the time to be committing new money to any asset market, given the uncertainty. And what the market is telling you is that they are uncertain. So the rest of the week, is going to be secondary jobs data, some other secondary data, and then the big NFP data. And that's going to be a focus of the Fed and has been a focus of most of the governors, except, as I mentioned, Waller, about seeing any weakness in the job market. Consensus is about 140,000 jobs, 160,000 jobs, and the unemployment rate is not expected to change. What do you think happens next week?
I think if NFP is hot, let's say 175 plus, the bond market will probably, let's see, it'll bear flatten, i.e. the 2-year note will suffer by 15 basis points or something like that. It's very unlikely that the market prices in less than the 2 cuts that would been promised by the Fed for 2024. That's almost an impossibility. And it'll always keep a little bit of a cushion just in case they go 50 1 month. I think 1 month worth of data is not going to be enough to change anyone's mind about the employment situation. It's going to need several months of strong numbers for people's opinion to change. So the market would react much more to cold data, say 100, 110, or even lower. If the number is lower than 100, I expect the market to price in immediately 250 basis point cuts for 2024, which basically means that's another 20 to 25 basis points at the very short end, about 20. So there's more room for rallies than there is for falls, and in case of a cold number, then the market would bull steepen, so the short end would go up in price more than the long end, and that tends to be supportive of equities. But in any case, it would be a bonds over equities kind of move, because equities are very, very fully priced, and you could get a I wouldn't say that they're going to sell them very hard, but they're certainly going to sell them by 1% or so, certainly relative to bonds, because it just gives you that little bit of extra pricing in bonds that you have to price in a little bit of odds of a recession. Now, I don't think that we're going to have a recession. I think that's completely the wrong thing to think about. But I think at the moment, very small odds of a recession are being priced in the bond market. It's more of an inflation story rather than a recession story. So bonds will do better than equities, I believe, on a very cold number, and the colder, the more bonds rally, and that tends to support equities. But certainly, I don't think that they'll be going up in that scenario. They'll be unchanged to down. What do you think?
Yeah, it's interesting. Our view on the economy is heading toward, we have slightly different views on how we get there, but heading toward target on inflation and strong growth that favors equities over bonds. But at the same time, both Nick and I are of the belief that we have this great uncertainty in the next month. Volatility is very high, which indicates markets are uncertain. And there's limited upside to equities given its pricing. So for me, the point on the employment number is that what Nick described as a bull steepener in a cold number and a bear steepener in a hot number, the transmission mechanism to equities is one of equities pricing on their multiple. Because a cold number, if it's extrapolated to a recession, is bad for earnings. But a cold number, if it's not extrapolated to earnings, that earnings are fine, but allows the Fed to cut more than they want, is supportive of equities. And so I think equities are priced here, mostly resting on the rate cuts and not resting on economic strength. So I would think, for that reason, bull steepener is supportive of equities, bear flattener is bearish equities, and that the earnings pass through of those numbers, which are contra to those things, are going to be ignored. And so I agree, you might get but basically the point being that on a hot number, it's stocks over bonds. In a cold number, it's bonds over stocks. But at current pricing, neither of those things are attractive enough to add risk on.
Yeah. As we said in the beginning, precisely the wrong time to be adding much risk to your portfolio. Great. Thank you very much indeed, and speak to you next week.
See you next week, Nick.